Well, guys, it's been a while since we've had to discuss this chart, central bank liquidity. But as it turns out, it looks like it's back on the rise. And contrary to what we just saw from the Federal Reserve and Jerome Powell, they are trying to support one particular market. Can you guess what it is? Well, in today's video, we'll take a look at it together, along with what's happening on the most important market sector, semiconductors, as they continue to see weakness. And of course, everybody goes towards safe haven demand. The US may not be the number one market anymore, according to some people. Today, we look at the bankruptcies that are on the rise and why everyone is choosing a couple of shiny metals. Let's go through stocks, commodities, and cryptos to see what's next for markets. Join us, guys. This one's not to be missed. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss together. The latest macro, the big data, the dark pool liquidity, the options flow, and then of course, the bankruptcies and what Jerome Powell just said. If it's your first time here, remember to subscribe and smash that like button if you love markets like we do, as we do this on a daily show. But on top of that, we've got some amazing stuff to share with you. So let's jump into it straight away and have a look at that correlation that we've used several times before, which is Nvidia versus Cisco. Are we in some type of dot-com boom to bust that we don't even know about yet? And yes, I know the argument here is, of course, totally different when you look at valuations. One thing that is pretty similar, though, seems to be the overlay chart. If you take 1996 all the way to the 2000s boom and then bust, you'll notice that Cisco and Nvidia seem to be following a very similar path. And that begins this most important level. If we start to lose structure around here, then of course we will literally be on the recessionary path and things really will be dire. But if markets are able to regain certain highs that we'll look at later on today's video, that could be a huge deal. So let's break down what everybody is saying. And of course, we'll start off here with JP Morgan and their latest call. We posted this over on our X account, links in the description down below. But basically, it's more of the same. Bank of America, Goldman Sachs, JP Morgan, everyone's downgrading the US. And now they're saying their worst case scenario is 4,000. I tend to believe the worst case is much worse than 4,000 if things really go bad. But either way, they've downgraded it. And now their base case is 5,200, funnily enough, exactly where we pretty much are at the time of this recording. And their bull case is 5,800 by the end of the year. So what they're predicting is up, down, and all around, basically this all the way through to the end of the year. Now, will that happen? Well, let's take a look at some of the things that Jerome Powell just mentioned over the last 24 hours in his meeting. Now, basically, we saw here a very interesting comment. Jerome Powell was asked if the Fed will step in and support the market. Basically, he said, no, I think the market is functioning as it should be, even with the current uncertainties, obviously talking about the tariffs. And he's basically saying no bailout is coming for the stock market. But that being said, as we've seen recently, there are signs of liquidity increasing in markets. And particularly, we think that Jerome Powell will be supporting the bonds market. So will there still be a plunge protection team? I think whether that's, let's say, the administration or it's Jerome Powell, clearly something will be going on because we already saw someone blink and we are starting to see central banks around the world pay a lot of attention. Have a look here, particularly at the new all-time highs. Almost every central major bank in the world is actually pumping M2 money supply. And a lot of people liken this to Bitcoin, as there is some correlation we'll look at in some upcoming videos. And of course, they also liken it to certain things like gold and other markets going up. So the US monetary supply looks like it's actually going to a new all-time high. We've got China absolutely pumping, which is part of the reason we've been so bullish on market structure. And as you guys know, this is often the early stage of forming a base support. Now, that doesn't mean we can't hit 4,700 on the SPY together. You know, obviously that could be hit, or we might actually make new lows as that would actually entertain. But it does mean that generally speaking, you're looking at high volatility to create some form of structure. And this is where our concept of patience, react, don't predict comes in very clearly over the next coming sessions. Now, Japan and Eurozone and UK and Germany and everybody else also are doing something very similar. So it's a very interesting thing to track. And obviously we will be tracking M2 money supply along with other liquidity injections over the next coming weeks and months. Now, another thing is, have we actually hit extreme fear? Well, you can see here on this chart, if you're taking just the AAII sentiment surveys, which obviously we have for a long time, then yeah, we've kind of hit maximum fear. But one of our good friends here, Grant Hawkridge, has gone through, and what he's actually done is he's looked at all of these reads together, including put-call ratios, bull-bear spreads, NAAIM reports, etc., etc. And he's actually put them in with all of the great lows. And I think this is an excellent chart because what it shows you is that we may have hit the extreme low, but if we're going into, let's say, some form of recession, significant pullback that's going to last, then we're not quite at those extreme periods. So, of course, there is more room to potential downside from that aspect. That being said, a lot of the temporary low periods are coming up. So I'd be looking forward to seeing the next week or 2 weeks worth of these reports. And hopefully Grant, I'll have a chat to him, will continue to make this report for us so that we can therefore share it with you guys and be pretty clear whether we've actually hit a rock bottom low in that aspect. A really cool chart, well worth checking out. Now, what about first quarter bankruptcies? This is going to shock a lot of people. Bankruptcies are up big time, and you can see we are now at the highest level of first quarter bankruptcies since 2010. Now, this may look at this point, wow, shocking. Of course, you think, wow, bankruptcies are up, tariffs are taking control, market's screwed, everything's bad, nothing's going to work out. But you do need to remember to put things into, of course, some form of, okay, is this normal to see bankruptcies up quite a lot? And you can see here, yes, it is. Although it is elevated here, no doubt, in 2025, it'll be interesting to see how the lower level of bankruptcies that tends to come through April, May, and June tends to come through this year. But yeah, bankruptcies are increasing. And obviously the real case of where bankruptcies are expected to spike, at least in our eyes, is going to be the back of this year, third quarter, fourth quarter. And that's going to be because there are so many refinance companies coming up that need to get backing. And that may be very difficult in the current environment. So are there still some good cases for the markets right now, even though they've pulled back to 5,200? Well, it turns out there are a lot of options sitting here, but also CTAs are still expected to be a buyer during, of course, the month of April. And we are also on those kind of, I say narratives of the 1960s or 1990s period where you might say, okay, yes, we've hit the level based on the Cisco chart, but we also have overlaid very nicely so far with both the 1960s run and the 1990s run, as this is a dip that is therefore bought, but it is still near the end of a serious cycle run. So you've got to remember in both of those cases, even if we do follow a new all-time high, you can never forget what we've just seen here this year, because luckily, well, not luckily, generally this is where the damage has been done. So actually damage gets done, markets still go on like nothing's been happening. Everyone thinks, oh yeah, it's all good. And then it's really not very good at all. Now, if we are to see a market go towards the V shape and recover, this is around the level that we tend to see it. Now, you might think, of course, the last 24 hours, things got really wild, but you've got to remember that we're in a structural zone of 1,000 points. And you would say, what are you talking about? It's 1,000 point structural. Well, we're in a VIX plus 30 environment. So yes, we are in that type of structure. The way that this plays out over the next 1 to 1.5 months could be the most important level. We've said this for now, literally a month. So we knew this was going to be an important level. This area here will matter to the recessionary structure, which we may actually already be in, or of course, the recovery structure. And this is really where we're going to see stocks like Nvidia, semiconductors, and of course, many others hold up or not. In terms of people fleeing the US, their storyline at the moment is, of course, the end of US exceptionalism. I don't believe that happens overnight. So, I think that this story is getting blown out. I've seen this story run many, many times over the last kind of 15 years. And of course, it's always been wrong so far. You may argue that it could be having more merit this time. And no doubt these reports, the latest ones here from Bank of America, are showing you April 25. But do you think it's the end of US exceptionalism in terms of companies and stocks? I'd be interested to know what your opinion is in the comments down below. Maybe we'll do a poll on it soon to see what people's thought process is. But in general, these are the forward-looking indicators that people are using. And you can look at these and say, oh, yes, things look pretty dire. But at the same time, again, price will be everything. And what we're looking for is we're looking for these big flows, these big dark pool liquidities. What is Wall Street actually doing, not what they're saying and claiming. S&P 500 post one-day massive 9% return, such as last Wednesday. As you can see here, it's pretty usual to see an up, down, and all-around market. That's exactly what we're seeing. We've gone up. We've come back down, we've gone back to the same high, we've come back down, and we're actually trading in a bit of a range at this point on the charts. And as you guys will see, we're now at what we would call a significant put support. One thing that isn't trading at range, though, is gold. I mean, this thing is absolutely flogging, and it is probably on target to hit our second and really final target at so far, which is 3,600. Now, a lot of central banks are buying, but at the same time, a lot of big banks are actually supporting that 3,600 target. Very weird that they've all come out with pretty similar targets. In fact, Goldman Sachs now is sitting at around 3,600, up from, I think it was like 2,950 or 3,000 before. So a lot of people are looking at gold. It's pretty much catching storm fire, and this usually means that everyone's going to pile into it. It is the most worrying time for gold traders in some ways because everybody is looking. So what this usually will mean is there'll be a lot of people starting to bet on it, and maybe we'll see some very outlandish candles over the next couple of weeks. And I'm actually looking for that because if we hit 3,600 very quickly or get close to it, that could be a big warning sign for gold, at least temporarily. Remember, if liquidity was to dry up, which it isn't at the moment, M2 money supply's up and other things are up, then we could be in, of course, a liquidity crisis. Gold will not do well in that particular time. Let's have a look at another chart here from Subaru Trade, which is the percentage of stocks below their lower Bollinger Band. So basically, this means markets oversold themselves. And of course, when a market oversells itself, what happens? You often see a mean reversion. Now, you'll notice that when this happens, it's usually what we call a panic crash. And 1 week later, which is what we're in currently, this data was taken as of the weekend, you can have up, down, and all around. 2 weeks later becomes more green. 1 month later certainly structures up traditionally better. And then 9 months later, well, actually, the stats are very, very bullish indeed. But if you have a look here, this is what happens a few days later. And you guys will notice that it's pretty sketchy when it comes through to the next week. Coin flip type of material. So no surprises that we're starting to build structure around here and we're seeing up, down, and all around. Now, does that make sense also from the dark pool liquidity? We've already seen huge Q trades at the highs, which is the resistance area. We've seen huge Q trades where we're finding ourselves right now. We're kind of stuck within those two range zones. You will notice, though, there are a couple of really large trades. I want to point here the largest trade that we have now seen on gold on PHYS. Now, this is a big one, and this doesn't necessarily mean the high is directly in, but I tell you what, it's a massive dark pool, and it has happened. So just like the massive accumulations of back in 2020 and 2023 before gold went ballistic, this is one of the largest trades, or it is the largest trade we've seen on this particular ETF. There's a big one. It's the biggest one we've ever seen, and it's happening at these highs. What do you guys take of that? I could be getting close, if you know what I'm saying. Now, let's have a look at PLTR, another thing here that's been going up pretty strongly recently. The number 1, not a dark pool, but a big sweep near the end of the day, coupled with the number 4. They did end up selling just after this particular read. So has PLTR come back too heavily too quickly? Maybe. I mean, as you can see, it's a 2 times long, so it's most likely a target or a take profit. Now, I thought I'd just include a couple of the previous ones we'd shared here in terms of large activity. This was taken as of before the sell-off of the last 24 hours. Again, kind of stuck within a range. This is basically 5,200 on the SPY, so no surprise that we're getting there. And yeah, people are basically trading the range. You can pretty much see this. Sweeps, dark pools, everything. Doesn't matter which quality fund, NASDAQ, S&P, they're all kind of buying up to the high and selling off into the low, and then of course buying back up again. Now, we do have a big Thursday. This will be probably this is the most important day of this week other than the Fed, which is TSM and Netflix. These are the kickoff of the 2 tech stocks, but of course next week and the week after will be the ones we need to watch. And I just leave this chart in here just to recognize that, okay, we entered a bear market. Traditionally, it's very difficult for this to be a soft landing. We're going to need everything to work out. We're going to need deregulation, further tax cuts, an accommodative liquidity supply from the Federal Reserve and central banks around the world. Maybe we've got that, but they haven't told us we've got it. Why would they? And at the same time, we need to dodge a lot of poor recessions in the past. So yes, we entered a technical bear market, and they do tend to be kind of bad. Now, when we have a look at rotations of the last 24 hours and last 5 days, you guys can see here it's been more of a defensive kind of market, which makes sense. And if you have a look over here, the last 24 hours was a little bit more defensive. Now, what that's telling us is that as we've rallied up, it hasn't been semiconductors forming this structure at this point. It hasn't been people buying technology stocks and saying this is great. It's been people taking profit and rotating into defensive sectors. it's not exactly the thing you would really want to see here at these resistances. So as we look at the charts here, you can kind of see what's going on. Some people will argue this is some form of island reversal, gap up, 2 days sitting at the daily 20, then gap down. You can see here clearly that this 5200 level is a major support zone and very important. And what we'll do is we've actually left some gaps here. So we'll jump on over to the S&P futures so you can get a bit of an idea here. So this is the 5200 level. This is actually where we've got 52 to 5250 is where we have a lot of puts. And you'll notice that's exactly where the market came down to over the last 24 hours. Now, for this market to go bullish, you're going to want to go past this high over here, which is also going to fill gap. And this is going to be important because if it gets through here, then it's actually starting to put in a little mini sequence of bullishness, and then it could push 5600. On the downside, if we get through 5200, that could create what we call a cascade effect, which we've seen a few times. 5400 was the other notable cascade effect over here, where we hit that level, there were lots of puts, and then as soon as it went through it, it just triggered a huge amount of hedging. So at this stage, the problem is we have the most traded zone and a massive gap fill at 5670. We have, of course, the possibility of markets going bullish if we get through these zones up to there and then having problems. And if a bear is going to take control, really what they've got to do is push this low. 5200, they've got to push through it. If that happens, it could create a cascade effect. Next stop, maybe even 47. Let's have a look at the actual options themselves. You'll see what I mean. Massive options expiration here on the 17th of April. And you guys can see here 5250, 5200. Wow, that's a lot of puts. So huge amounts of puts, huge amounts of, I guess you would say, almost the market not wanting to go through those zones, because if they do, they're going to need a lot of hedging. Remember, who writes a lot of the options? The market makers themselves. They will need to hedge off these events if it does occur. And it does make sense to hold this support. And I kind of looked at all of the other majors, including, of course, the other major stocks we look at. Tesla, 240, massive amount of puts. Again, could be a significant put wall here that's just appeared as of Friday, stabilizing force. And then, of course, we've got 105 stabilizing NVIDIA, even after that bad news on semiconductors, which happened yesterday after the close. We still have a 105, 100 kind of massive put support now. So 105's always been a put support, but it seems to have enlarged itself over the last 24 hours. So this is going to be the big support line in the sand. It doesn't really matter what stock we're looking at, what sector we're looking at, what index we're looking at. All of these particular markets seem to have a ton of puts right where we are at the time of this recording. So it would make sense maybe that the market would try to hold above this at least for the Thursday session leading into the long weekend. Now, more importantly than this though, if markets do rally back up, then we could get to that 56, 56.70. I still think that's a huge deciding factor. Now let's jump on over and have a look at the charts. First up, let's have a look here at the bonds market. The bonds market was stable, I would say, over the Fed Chair Powell's discussion. Yields went down, not up, which is okay, that's good. And spreads actually came down with the latest data. Again, not a bad thing. When we have a look at central bank liquidity, though, you'll notice that both world central bank liquidity and the US central bank liquidity, which is this green line here, have both started to increase. And this is not just money supply. This is actually a mixture of a whole bunch of liquidity across the board. Now, if this continues to accelerate at fast rates, we might be seeing more of what we did over the last couple of years, which was an accommodative central bank kind of liquidity being injected to keep markets afloat. So this is more, I would say, for the bonds market, but still liquidity floats everywhere. So this will be absolutely important. And I know that Jerome says, oh, we're not doing it. But you've got to remember there were backdoor methods that they used since 2023 to 2025. This time around, they might be using the more traditional techniques. Well worth watching. We'll keep tracking it. What's going on with the dollar? Nothing. Structure at around 100. You know, this 99 parity to 100 is a structural zone. So obviously, we're going to have to see how that plays out. And gold continues to fly. Has everyone started talking about it? Yes, everyone is talking about it. These are very large, very big moves. And of course, at this stage, you ride the trend. The trend is your friend till the very end, as they say. But at the same time, we do need to recognize the number one largest trade on one of the biggest ETFs just came through. Silver's doing well as well. Comes back down to support, finding a little bit of a buyer at this time. Obviously, we need to get silver through this area up here as 34 plus, 34.50 plus. And if that happens, silver will be free to potentially move into the $40 an ounce target. So we obviously want 45 ultimately for that. US oil also on the improve here, guys. Look at this, inverse head and shoulders, basically breaking the head and shoulders pattern neckline at this stage. And again, that's pointing towards a little bit stronger on oil, and that's a good thing. 240 seems to be support for the next 24 hours on Tesla, and 220, and then 280 and 300, of course, on the high end. But Tesla is, remember, in a trapped range. So a lot of you guys want what's happening. Really, it's about these puts. It's about the options market more than anything else with Tesla as it's trapped in a zone. With NVIDIA, it did start off really bad. It ended up pretty much neutral on the gap down. And look, the only thing you've got here is an anchored VWAP. So off the low, you've got an anchored VWAP low. You've got a little bit of a fib. That's about it. So other than the options at 105, 100, I wouldn't say you have a great technical level or anything. We certainly haven't broken back above. You've got to remember that at the moment, that semiconductors chart, semiconductors and semiconductors versus SPY, they're really struggling. Every time this market comes back to this daily 20 moving average, it rejects. To really start to build some buying pressure, we need to breach this. We then need to take out this lower high. Now, if we do that, great times. That's an excellent signal that the markets really want to actually find recovery, and the worst could be behind us. But for now, the worst chart is that semiconductor SPY chart. That absolutely looks terrible. PLTR has recovered well. Again, massive trade coming through. Take of it what you want. It's at resistance. Obviously, there's been a little bit of reaction. I would say it's a sell. That doesn't mean that it has to sell straight away. It can go higher. It's just that someone made a big decision, I think. HSI doing okay, not too bad. Of course, we know that Chinese central bank is just pumping liquidity right now, going ballistic, trying to get this market back up. And that's been one of the reasons we've enjoyed the Chinese market over the last 1 year in particular. But it was really just mostly just great structure. The structure had improved a lot. Obviously, now we're in trade wars and all sorts of things that are not going to be good for China at all. But they will continue to push liquidity. Once they start, they don't stop. And you guys know that because we've experienced it with the Fed and, of course, the Bank of Japan over time in particular, and then the EU as well. Now, let's have a look here at the NASDAQ. 20 moving average, still too much for it. Obviously, gap up, gap down. NASDAQ will show that. We haven't really done anything in particular that's that interesting. We've come down to the support. We've found a bit of buying pressure. For the NASDAQ, you're looking at 18,750. You get through that, we might be able to push that 19.6. This is the most traded zone. Now with the Russell 2000, unfortunately, it's kind of like even doing nothing more so than the other two, which is that it hasn't shown as much weakness, but obviously it's not really doing anything great technically. Again, I'd be looking at the NASDAQ and the SPY. And then if you wish to trade the Russell accordingly, you could do so. What about Bitcoin? Well, a lot of people will be celebrating the increase of M2 money supply because there is a correlation with Bitcoin, at least it looks like there is. We'll explore that soon. But at the same time, we're not back to that correlation up here. So that makes sense because, of course, the S&P, the NASDAQ, they all lost value. So really, you'll be looking for the S&P to break those highs, the NASDAQ to break those highs, and that to potentially push Bitcoin back up to this resistance, completing that kind of double bottoming pattern. At that point, we're going to see a big decision. Does this market really want to structure back up and start repairing, or are we in something much, much worse? For now, the VIX is so high, it's above 32, as you guys can see here, 32.6. But whenever you're this high, you can have to expect 5, 6, 7 even percent days to come out of nowhere. And obviously, we're going to have to see de-escalation of tariffs very quickly, a lot of rollbacks on them, and more importantly, more of this liquidity coming in from the Federal Reserve. Thanks so much for watching, guys. Just remember that we do have a long weekend this weekend, so I want to wish each and every one of you a great time with your families. Hopefully, you have a good long weekend. And obviously, in terms of following us and checking out everything that's going on, we will be producing a video this weekend. We will also be updating plenty of charts on X. So follow us over there. Make sure to follow me on LinkedIn. Might post a new one next week in terms of some psychology, and you can do that. Links in the description. Follow Thomas.